But Brad, we had some feedback from our users that they don't fully understand the real estate investment trust area of the market. Now they've started to gain a lot of interest in it, the safe dividends that you've been talking about for some of these companies, the potential for nice retirement income or vacation income, whatever they might want to use it for. I was just wondering, could you take a moment and break down what makes these REITs so favorable to investors instead of any other place to find potential income?
Sure, and it's great to be back on again. And first off, I want to say the first thing we do is we look at the macro news and what's going on, at the big picture. And I got to just say, I just subscribed to EPB Macro Research. This is not a paid commercial. I've been listening to Eric now 3 times in a row in these podcasts, and he does an excellent job breaking down macro level news. So great job, Eric, and I'm now a subscriber. So that's the first thing I do. The second thing we like to do is just look at, the real estate sector, the REIT sector, I should say, is very broad, covering many different, property sectors. In fact, a lot of these sectors that didn't exist 10 years ago are some of the best property sectors to invest in today. For example, cell towers and data centers, we call those the prop tech world. We have a number of other property sectors, subsectors of this net lease sector. We talked about last week being the gaming sector. So a number of different ways to play it. So it gives you a lot of diversification opportunities. And an investor can really build their portfolio designed around their risk tolerance levels, looking at the macro picture, looking at things like Eric reports on supply and demand. All those things are really important, but you have to look at those individual property sectors when you're building your portfolio and designing, what are you looking for? Just income? Are you looking for total return? But overall, what really the magnet for REITs is the income. That's, again, I talked about this last week. REITs, by law, must pay out 90% of their taxable income. And that's what makes this sector extremely stable and predictable. Now, not all property sectors, we're seeing a little volatility in skilled nursing today as a result of labor shortages. And so some of the sectors certainly do have more volatility than others. And that's why each investor should, allocate capital based on their overall risk tolerance, building out their portfolio, looking at all the various different types of property sectors. And obviously, hotels for today are extremely more risky. We're seeing that volatility. One day they're up, next day they're down. And there's a lot of stability in a lot of those other sectors, especially those longer duration sectors, longer duration lease sectors that report on, like healthcare would be one example, or net lease and industrial. So but it's a very stable and predictable property sector. And that's really, I think, the biggest, value proposition for investing in REITs.
Gotcha. And let's say that investors come to you and they say, hey, I'm either risk averse or I love taking risks and they want to invest in REITs. Do a couple subsectors within REITs come to mind for each of those groups that they can then start exploring down further?
Yeah. So again, I think the biggest thing right now, especially in this environment that, again, Eric just talked about, inflation and rising rates. And so we really have to, think about those in terms of what's going on in the big picture. Inflation is definitely an issue. And it's, even though REITs have performed well in inflationary environments, we really haven't been in an environment where we're in right now today. There's a lot of different things out there that make this a different story than we can rely on in the past. So I think the one thing we look at is growth. We want to see not only that the company has a safe dividend, but it's able to grow that dividend at a fairly good clip. Again, we've got this inflation sitting there, so we want to be able to see not just some very modest, 0.5% increases, but we want to see very stable dividend growth. So what we do is analyze and really dig into the fundamentals of these companies to determine, is that income sustainable? Are they able to continue to generate the same earnings, which of course we call that adjusted funds from operations or funds from operations. So are they able to still generate earnings growth and income growth, which is the net operating income, the rental income for the property, and grow that dividend? Then we also look very closely, in fact, almost in a granular sense, the payout ratio. Again, we look at the AFFO, which is really the most the proxy for that dividend, and before it's paid out to the investor in the form of a dividend, So we look at the payout ratio, which is the dividend divided by the in our world the AFFO metric, and we want to make sure they've got a good margin of safety, in that dividend payout, and they're going to be able to grow that dividend. And so looking at things along those lines is really important. Now, what's really interesting, and I just wrote an article about this today, and there's been five since COVID began. There's been 5 different M&A deals, and these are REIT to REIT M&A deals. There's actually several private equity deals as well, where REITs have been taken out by other companies like Blackstone or KKR. But I want to highlight these, and this is important because we always like to talk about scale advantage. I mean, one thing about REITs own approximately 10% of all commercially held, institutionally owned properties in the U.S. I'm not counting houses, but just commercial real estate of institutional quality is held by REITs. So that means there's a lot more opportunity set, broadly speaking, for REITs to absorb or consolidate portfolios. But now we're seeing really through COVID, over the last, say 12 months, we've seen companies like Simon and Taubman, merge. We've seen companies like Realty Income and VEREIT merge. We've seen companies like Kimco and Weingarten merge. We've announced, and we're going to see in the first quarter, Vici and MGM Growth Properties merge. And then more recently, we hear about American Tower acquiring CoreSite, which is a data center REIT being acquired by a cell tower REIT, American Tower. So there's 5 deals. What that tells me is, and we own positions in all of these companies, Simon, Realty Income, Kimco, Vici, and American Tower. And the reason we own these, and the reason we're going to continue to own these, is because we understand the game is all about scale. And you've got to have cost of capital to scale. So what we do is look very closely at the fundamentals of these REITs to determine their cost of capital, their liquidity, their balance sheet, so they can grow these platforms. And again, look at this M&A activity that was occurred just over the last 12 months. So that's a really good indication. I think investors should really be looking at, you want to own the big players, you want to own the consolidators, and watch them continue just to grind it out and grow and grow and grow. Because again, REITs still only own 10% of this huge universe of real estate in the U.S. and abroad. And so that's really the value proposition. But I would suggest to anybody watching this, always focus on scale and cost of capital. That's how you're going to win.
Yeah. And you mentioned in your note last week that industrial REITs has actually been the top performing subsector within REITs. Do you think that this is going to continue?
Yeah, I'll tell you, I think one of my biggest mistakes, and I've had plenty, believe me, well, one of my mistakes in COVID was I should have just backed up the truck on industrial. I didn't. Now, we did buy a lot of good companies during COVID, and we've done really well coming out of that. It's not hard if you bought at the very bottom, obviously, and there's a lot of success stories out there. But I wish we had invested in companies in March or April of 2020, like Prologis, which is the big giant consolidator. Notably, that is not a consolidator on the list that I own. I wish I did. I wish I would have bought more. Now, we bought companies like Stag Industrial. We've owned Stag about almost a decade. The company actually went public just around 10 years ago. And Stag's been a great pick for us. They've been able to consolidate. They're a little differentiated because they don't own some of the big LA market assets, and they're in more secondary markets like Greenville, South Carolina, where I'm sitting. That's their 3rd largest market. But the industrial sector has just been on fire. And a lot of that, and I just wrote an article, which will be published, I think tomorrow on Seeking Alpha, is the fact that, this e-commerce has really driven the demand for a lot of these last mile facilities. So these are companies like Amazon and FedEx and UPS and some of those buildings that are even the retailers that operate these logistics facilities. That's really what's driven the demand, is the e-commerce, and COVID has really accelerated that demand. Now, what's happened, though, is these companies have become expensive. Again, going back to pricing power, cost of capital, now the average multiple for the industrial REITs in general is around over 30 times, compared to is about 20 times about 5 years ago. So you've seen a big spike in terms of valuations. I think we only have one buy on our entire industrial list, and that's a really unique company called Americold, which invests in cold storage. Now they've sold off again because of the supply issues and the labor issues associated with cold storage, which has a service component to the business model. But overall, industrial has been a great place. Unfortunately, they're just all too expensive right now, except for a few outliers like coal, like Americold. But I think that's going to continue because you're seeing we went through all the third quarter earnings calls, looking at what the companies had to say, and you're seeing just accelerated rent growth around 10%, even 15% in some markets. So tremendous pricing power. Industrial is definitely a great place to invest in. It's just very, very expensive right now.